It doesn't get much simpler than that. What's in your wallet?
What's in your wallet? If you're an American, chances are it's a Capital One credit card. Capital One may be the largest bank you've never heard of, but with over 1 in 3 US households carrying one of their cards, it's a powerhouse. It's also the largest digital-only bank by deposits and the 3rd largest auto lender in the US. They didn't get here by accident. It's taken years of meticulous investments. 30 years ago, the founder and still CEO, Rich Fairbank, found a profitable niche, lending to the subprime market. These are your everyday working Americans, but with less than pristine credit scores. Competition in this segment was and continues to be low, and Capital One capitalized on this and went upmarket to take share from other players. They went branchless and focused entirely on digital distribution, which keeps costs low and allows reinvestment in marketing and products. They're tech savvy, an original fintech. Capital One was profitable during the GFC, and earnings per share have more than doubled over the last decade, a testament to their data-driven risk management culture. But what we also like about Capital One is that it's not a bet on where interest rates are going. As rates have gone up, Capital One's charged more on its credit cards as their floating rate, but as a digital bank, they've had to pay more for deposits, currently around 4% versus peers like Bank of America who are paying just 1%. So they didn't see their margins expand initially, unlike other banks. But when you're paying 4% for deposits, there's now plenty of room to cut them and protect your margins compared to peers. The other opportunity is the proposed acquisition of Discover Financial, a credit card issuer with a payments processing network that connects consumers, merchants and banks, much like Amex, Visa and MasterCard. And Capital One would get ownership of this network. Credit cards are one of the most concentrated product categories in the US, with the top 10 players accounting for 90% of the market. The scale of Capital One and Discover combined would be the largest credit card player in the US by outstanding card balances, strengthening their competitive edge against JP Morgan and American Express. The vertical integration of the credit card businesses will see Capital One capture more of the economics, not to mention upside from accessing the data on Discover's payments network. And while Capital One is nimble and light, Discover is a less efficient legacy business, so there's scope to extract synergies. Capital One is a strong franchise on its own, but the acquisition of Discover can see it lift its weight in the industry. It's well capitalized, and at 7 times earnings, it's cheaper than peers. Even better, post-acquisition, it will have a sustainable return on equity above 20% and be on 5.3 times earnings. This is compelling pragmatic value.